Your life journey doesn't stand still, and neither should your wealth. Welcome to Wealth on the Move, the podcast. Will Hoffman offers investment advice through Private Advisor Group, which is a federally registered investment advisor. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult with the appropriate qualified professional prior to making a decision. Welcome back to another episode of Wealth on the Move, the podcast. I'm your host, Will Hoffman, founder and president of Hoffman Wealth Management. And today we are going to talk about it. If you've read the newspaper, watched the news, checked out any financial information, you know that the new One Big Beautiful Bill is here. It is law. And now we are going to learn how it affects our money. Yes, these are the droids you have been looking for. We are going to abbreviate this and call it OB3. It's going to sound a lot like a Star Wars droid. And I have a guest that I'm just getting to know, excited to have met. And she is going to be our guide through the new tax One Big Beautiful Bill. I have Kelly Bender, president of TBS, or Total Business Solutions. She is a tax wizard, and she is going to help us learn all about how this affects our money and how we can use it to our advantage. So, Kelly, welcome to Wealth on the Move, the podcast.
Thanks, Will. I'm excited to talk about the OB3. So
OB3.
I like that name. I called it that right from the beginning and had a little pushback from some non-nerds, but we're going OB3. That's what we're calling it.
These are the droids you're looking for, and it's hotly contested. Before I let you introduce yourself, I do want to include a giant disclaimer. We are not going to be giving our opinion of the One Big Beautiful Bill. I know that anytime something becomes law, there's always some debate. There's always winners. There's always losers. There's always folks that love it. There's folks that hate it. This is by no means a political commentary on the One Big Beautiful Bill. This is, now it's law. How does it affect our money? How do we use it to our advantage and keep more of what we are earning? So that said, Kelly, please tell us about yourself. I know that you and I are both fellow Pitt Panthers, so we already have that in common. But tell the rest of our audience about yourself, your business, and how you're growing that.
Sure. Thanks, Will. So, you kind of made a good introduction. I run a tax and accounting firm in the North Hills of Pittsburgh, and we have 2 offices up there. And we primarily specialize in servicing small business owners, specifically because there's a lot of complexities that go along with not just taxes, but payroll and bookkeeping and kind of strategic advisory as far as tax advisory goes. And so that's really where we focus on. In addition to that, we do a lot of tax planning and advisory services with and tax advisory. So we don't do any wealth management like you do. So tax advisory services with individuals who have what we would call complex tax situations. So generally speaking, these are individuals with various levels of investments, IRAs, and, complex situations where they need strategic guidance on how to best navigate what
I've
is
never
primarily
seen a non-complex tax situation.
Well, the OB3 is going to make everything even more complex.
Sure.
Even if you thought you were basic and you were TurboTaxing it yourself, you are no longer basic. Like this bill just blows up even more our crazy tax code. But it's going to be a little bit insane.
Yeah. And, we preach tax planning, not tax preparation. And our paths cross with accountants every day. Our paths cross with taxes every day. It's always interesting that, folks are and should be worried about their investments and how they're performing and what's doing what when. But taxes have an impact on all of that all the time. And unfortunately, or fortunately, I guess, depending on how you look at it, it can have a bigger impact than return. So it's so important that our professions work together. I know that it's something that I know, and I always say I know enough to be dangerous. We're not allowed to give tax advice. It's something I wish I knew a lot more about, and especially for my own situation. I mean, I'm a business owner, I'm an employer, and taxes touch every dollar that comes through this office. So I'm excited to get into this and talk about OB3. So I guess to get started, OB3. What's in it? What are the big changes? And where do you see this having an immediate impact right now on your clients, on folks' individual wealth or business owners?
Sure. Yeah. So, I mean, you mentioned we're commonly calling it OB3. You're seeing things like OBBBA, the One Big Beautiful Bill Act, because they had to
Yes.
add an act at the end. So some people are calling it ABBA. Like it's a boy band or a Star Wars movie, whatever it is.
So,
That
and
like
is that the official name of the new law?
it's it's actually not. So
Okay.
I think it's actually like resolution. I don't even know the number.
Well, I mean, like they call it Obamacare, but it was the Affordable Care Act.
That's right.
So, like, I know we're going to call it OB3 or ABBA, but I'm sure it has an official government stamp that it's called something else.
It does. And if I wanted to impress you with sounding super smart, I would probably tell you like what all the code sections, but I don't talk like that. And so
Okay.
that's kind of the other part about why I talk, and I'm an accountant, but I don't talk quite as nerdy as some. And I'm not going to like do a bunch of code sections on you and
Good.
things like that because nobody wants to hear that. And
Right.
that's not very exciting. So, yeah.
So back to the bill. What's in it? How's it affecting our money immediately?
Yeah. So the big things, there's actually a lot more in this OB3 than just taxation. But for our purposes and what I think affects most people day to day is that there was a pretty big compilation of things that got thrown in to blow up the tax code to even bigger. I don't even know how many pages the tax code currently is. And because this is so new, we're really on the cutting edge of even talking about it because realize once something is law, now the IRS has to provide guidance on it and then prescribe any changes that are going to happen to the tax forms, write new instructions and all of that. We don't have any of that. We're
Okay.
just talking straight off of what the law was passed and how we're interpreting it currently today. But there's still a long timeline for, the IRS to get up to speed for how this is going to look in reality by next tax season, because with the majority of things that went into the OB3, almost everything is going to have an impact on this upcoming filing season, which is going to be the beginning of 26 for 2025 income. So
Okay.
that's why it's so important to kind of talk about it, because in tax planning, as you know, if we don't make actions during the calendar year, we're usually leaving
Once the
money on the
ball
table.
drops, there's very little left you can do. That's right.
That's it. Yeah, we got a couple after the fact, but most tax planning occurs during the year.
Right.
And so that's kind of why we're starting to talk about it so much, because this really, really changes the game for a couple different situations. And some of it's permanent, some of it's going away. It's all over the place. And so I kind of have to understand how that means for everybody today.
Well, yeah, and it made some parts of TCJA permanent
Yep.
and updated some amounts and things, and we're going to get into that. So it takes effect now. I mean, it's in effect now. It's governing everything from January 1st of 2025 forward
Ooh, is
until
it?
that's my question. Is it?
So there's an interesting caveat to some it, because nothing is ever straightforward in the government.
Right.
So there's actually some of the provisions actually take place beginning after January 19th, which was actually the inauguration of
Okay.
the current administration. So that means January 20th is sort of the clock start for some of these things, specifically in the business world. In the depreciation, they went backwards, but they only went back to January 20th. So just in case I didn't already hate my life enough about trying to keep dates straight, if you bought a fixed asset from January 1st to January 20th, you get different rules in the year 2025, because why the heck not?
Right. Why make it easy, right?
Why make it
The
easy?
Aztecs didn't know what they were talking about with that calendar. We're going to use our own.
That's it. So some of these are 25, some of these don't come until 26. And so it just, again, is a little bit of a mixed bag about how much of it happens for this year. A lot of it goes all the way back toward the beginning of the year. Some of it doesn't happen till next year.
Okay. So the first thing, when it comes to just personal finance that are really going to impact everybody is there's some adjustments to the income tax brackets, correct?
So we made, yes, essentially there were some adjustments to income tax brackets, but a lot of people aren't going to feel these. And the reason is that you mentioned TCJA, so Tax Cuts and Jobs Act. A lot of people call those the Trump tax cuts, okay,
Right.
from 1.0, from 2017. That tax law made a bunch of changes to tax brackets, but they were temporary and they
Right.
were all set to expire after this year. So that was kind of the reason for why we got this new bill, I think, in the when we did, is that if they expired, tax brackets and a lot of things would have gone back up. And so a lot of people would have felt the impact in 2026. Believe it or not, I mean, even though the law technically changed here with the OB3, what it's going to do for a lot of people is just give them a consistent runway to plan for, because now we're not going to lose that higher standard deduction. We're going to keep these, brackets where they have been in the 7 income tax brackets that we have currently. And they're going to pretty much stay the same and then stay tied to inflation. Most of things get tied now to inflation, meaning if inflation goes up 3%, the bracket goes up 3%. And that's kind of nice because some of these numbers have been around for a long, long time.
Yeah.
Although that means that I'm never going to remember another number ever again. Like I have no idea what they are.
So, but, and again, this isn't a political commentary, but why did that take so long? Inflation is it's the weather. We feel it. We know what that is. Again, we could go on and on. But why did it take so long for us to tie those increases to inflation?
One that they still haven't figured out, though, is capital loss carryovers. Okay. So that 3,000 has been the same number. I don't even know for how long. Longer than I've been doing taxes.
That, and the other one, Coverdell IRA contributions have been $2,500 for the 23 years of my business.
See,
$2,500 is half of your accounting book when you go to college, and we're capping contributions at that for what you can save in an education. Speaking of IRAs, we've seen some changes there. Can you talk about those with the OB3 and what retirement account changes are being impacted?
Yeah. So same thing. We just kind of got some tiers to inflation with some of the contributions. Those are going to, go up. Most, I think, of the changes that happened with IRAs and retirement accounts are largely going to have happened with Secure and Secure 2.0. So there's not as much in OB3 about retirements. There's some little kind of tweaky little things, but nothing really major. Most of the major stuff that happened with IRAs and retirement accounts happened with Secure and Secure 2.0, with, some of those changes to RMDs and things like that I'm sure you're dealing with all the time, and, how we have to distribute those assets. One little weirdo exception is that we got something new that sort of follows code section along with IRAs, but they're called Trump accounts.
Yes.
Which
my inbox was flooded on July 5th with questions about accounts for kids in these Trump accounts.
Yeah. So it's kind of interesting. They're, I guess, sort of looking like, and these are brand new, so we're all sort of figuring these out, but they follow like rules along the traditional IRA path in that they're going to, but also kind of Rothish. So they're going to be with after-tax money. They're going to grow, though, during the kid's lifetime. Annual limit on this right now is $5,000 going to be able to be put into it per kiddo. And then when they are 18, they can touch the money. So sort of like a baby youth IRA, I guess.
Yeah, like almost like an UGMA account, but with some tax benefits.
But with some tax bennies. Yeah, so that's kind of cool. The other little carrot there is if you have a new kiddo born, I think it's born in 25 through 28, the government's going to seed fund this account with $1,000 to start.
And they still may make retro contributions. Is that correct? That's kind of open-ended. right?
Yeah, you mean the 1,000 for the 1,000?
Yes.
Those
Yeah.
are going to be for, I think, as I understand, for all kiddos born in 25. So even if they were already born before the law passed,
Okay.
you're going to be able to do it.
But what I guess they're toying. Am I understanding it correctly? They're toying with going backwards from 25 once they figure out how to do this.
Oh, you mean for kids to be able to
Yes.
participate in them? Yes.
Yeah.
Yeah, they're going to be, I think, for all underage Americans.
Okay.
So under age 18 or taxpayers, really. So yeah, those are going to be for anybody under age 18 is what
Okay.
they should be covering, which is also kind of cool. And then there's a really crazy little thing in there where there's a little caveat for business owners where business owners are also going to be able to contribute into these Trump accounts on behalf of employees, but it's
Oh,
not
okay.
taxable to the employee, but as I understand it, tax deductible to the employer. So they're using it as a way to maybe give employers a way to incentivize, uh,
So I could
employment.
make a contribution to my employees' kids' accounts.
Yes, but tax free to the employee, which is kind of nice, like a
Nice.
tax free Benny.
Yeah. Brian, make sure we edit that out. No, I'm just kidding. So
We'll see how good of an employer he
yeah,
is.
that's right. So child tax credits, while we're talking about the kids, anything changing there when it comes to child tax credits or the family deductions?
Yeah. So child tax credits had been bumped up to $2,000. Those are now moved. They were set to go back to 1,000. So if you've
Okay.
had kids for a while, you probably remember in the old days, before 17, they were 1,000.
Right.
They are now 2, but now they're going to go up to 2,200 for 2025 per kiddo. And then same thing, those are going to now stay tiered to inflation, which again is good because if you have kids, they get cheaper every year.
Right.
Mm-hmm.
I did read on your LinkedIn page you're also a master of sarcasm, so
And that is correct.
I was tuned in there. Right.
I appreciate that.
The older they get, the more they eat, and that doesn't get cheaper either. All right, so now on to the grown-ups. There's also a senior citizen deduction, right?
Sure. Is that what you're calling it? The senior
Well,
citizens
let's call
deduction?
it the over 65 deduction.
I know some over 65s who are like, "Hey, I'm not a
I'm no
senior
senior citizen, right? The over 65 deduction.
That's right. So this is a new one that is getting a lot of unfortunate press because there's a lot of not factually correct information.
Okay.
So this is not no tax on Social Security.
Okay.
And that is what a lot of people have been saying. So this is not technically a no tax on Social Security. And that's important because just because you're 65, as you know, and some of your listeners might know, some people are 65 and are not collecting
Right.
Social Security. Some people could collect Social Security before age 65. So lots of kind of weird rules there. But
Sure.
the way that this deduction works is if you are over age 65, we're going to call it a new additional senior deduction of $6,000 per person over 65, regardless of whether you're on Social Security or not, still working, retired, all of the things.
Okay.
So
And that's per or 12,000 per married couple.
Or 12,000 per married couple.
Okay.
Yes. Mm-hmm.
So folks in their RMD stage are getting a little bit of relief when it comes to the taxability of those deductions that are necessary.
That's right. So it's going to be in addition to that new higher standard deduction. So you get that higher standard deduction that's been in place, but we're going to now get to keep that because that got permanent. And then if you're generally there wasn't a step up on that as well if you were a little bit older, and then you're going to get this new added senior deduct of 6,000. But this is a temporary one, so we're not going to get to keep this long term.
Okay.
This one is just for this 4-year window that we're going to keep. So a lot of these provisions, not everything, but some of these are 4-year provisions. So they weren't able to keep them long-term in the tax code. They're just going to
Okay.
be like a 4-year fun.
Okay. And then it'll all revert back or get renegotiated, right?
That's it.
All right. The SALT deduction or state and local taxes. That got a nice jump too, right?
It did. Yeah, that one got a nice jump. And that one, so, a lot of people didn't realize, except that maybe if they used a tax professional, they were like, I don't know, I don't itemize anymore. The SALT really was the main driver for why a lot of people stopped itemizing after Tax Cuts and Jobs Act. And the reason
Okay.
for that is that cap it went to a $10,000 cap on state and local taxes. I don't really understand all the reasons for why that happened, but for a lot of people, that kind of hurt them from the itemizing. So they got to take that new higher standard deduct.
Okay.
This was a little bit of a political football. And so somebody made the sausage in the back room on this one, and they took this now up to 40,000 is the annual limit on state and local taxes. And when we say state and locals, we're talking things like obviously your income taxes in the state where you live in,
Right.
maybe local taxes. I'm in PA, we have a local
Right.
tax, and then real estate taxes. So this is really where some individuals spend significantly more than $10,000. Now they're going to go up to 40. But again, once you get to the 40, there's also a whole bunch of higher income situations that start to pull and claw back that number. So it's not as easy as saying it's 40 grand for everybody, because of course all these things have income limitations based on AGI and all that kind of fun stuff.
So, and then kind of the last thing when it comes to just regular individual Americans, not business owners, what impacts on capital gains and estate taxes?
Yeah, capital gains didn't have any major changes to it. Estate did. So this is where we made permanent this larger estate tax limitation. And I didn't write this number down. I think it's 15 million in assets.
Yeah, I think it just made that permanent.
They made that permanent, right?
Right.
So I think they took that number now to 15.
Okay.
And per individual. So when we say that, that's one of the few things here, because most of the time we're talking about taxes, we're talking about income taxes.
Right.
These are based on, and this is where it gets a lot of people confused, particularly with gifting, or people are like afraid of taxes when they die. If you're not, like, your assets are not worth more than $15 million, you're not going to pay any
right,
quote unquote death taxes.
Death tax
or that's a good thing for the majority of Americans. And this is where this made that limitation, that 15 million, and that's a per person. So if I have a married couple, we're talking about, we'd have to have a $30 million estate before we're worrying about taxes at death.
So what are the big planning opportunities that individuals need to be thinking about now that they weren't thinking about at the beginning of the year to take advantage of this so they can benefit from it?
So I have two that I think for individuals are really important to understand. There is some very different language in some of these provisions, and it's not all of them, but it's definitely some, where married filing joint filers are going to significantly win from the tax situation versus married filing separate. A bunch of these provisions actually are completely excluded for married filing separate filers, which is a big change. Now, there's always been a few of those things, but this is pretty substantial. So if you were somebody who was historically doing married filing separate, maybe you had reasons for that, but I think this is probably time for a good consult with a professional advisor, because you need to understand that these could have some pretty, like, thousands or tens of thousands of dollar implications given the way that some of these rules now have been changed.
Okay. That's good insight. Thank you.
Yeah. And so I think that's a big one. And then I think the other planning opportunity is with this senior deduction that's here for the next 4 years. And you mentioned RMDs. I'm seeing this as an opportunity for my older clients who are already or potentially taking RMDs, or maybe want to consider some Roth conversion opportunities and things like that, is that they're going to basically have this benefit of an added $12,000 deduction, tax-free money. Maybe there's some ability to move some assets around into a tax-free situation for longer later in their life after this, kind of temporary provision is there. So I think those are the two big ones I see for individuals right now, where if you're in one of those scenarios, you should, kind of have a consult or talk to your tax advisor
Yes.
mid-year or your financial advisor and kind of just plan for what that could look like for you.
Back to the over 65, does that start the year that you turn 65? So if somebody is turning 65 in September of 2025, they can use that. They don't have to wait
Yes.
until the beginning of 2026.
No. Yeah.
Okay.
That one's going to be basically your age at 12/31 is normally how these have been, is
Okay.
you get the added deduct.
Okay. Awesome. Great
Mm-hmm.
insight. Thank you.
Yeah.
All right. On to our business owners. And I know this is the part that you and I are sensitive to because we are business owners. That we have, I know that I have questions and how this is, this is going to impact me, how it's going to impact my employees. So, what is the biggest impact for business owners? What are the big opportunities? Let's start with any new tax credits or deductions for business owners.
So the big things for business owners, and this is really where I was watching this very closely, there was a very big potential tax increase coming for small business owners in the form of the QBI, which has been around since Tax Cuts and Jobs Act.
Right.
That was this additional 20% reduction in the amount of income that we would pay tax on for small business owners, essentially.
Yes.
And that can include people with rental properties, entrepreneurs of all sizes. And
it's all business owners, or didn't that start as service business owners? It wasn't necessarily every business qualified for this, right?
Not every, but in small business world, the vast majority of small business pass-through business entities qualified.
Okay.
So the vast majority of people who owned LLCs and S corporations and Schedule C, single member LLCs, or people who just have side hustles even, and rental properties, like all of those qualified for this QBI, which was this 20% reduction. And the reason that we got that was that they cut the corporate tax rates back in 2017 for larger corporations, and they brought those tax rates down to allow the US to stay competitive. But in doing so, they've actually would have made small business owners pay more in taxes than large corporates. So they didn't want to do that. So they brought in this 20% QBI, which has been a godsend for a vast number of small business owners. That provision, though, was temporary. The big corps got the permanence, and we didn't as the small business owners. So a lot of us were a little worried because this would have been a really big tax bump for us.
Yes.
If we didn't
I know the Hoffman household was on edge.
Yes. So now we get to keep that. So QBI was made permanent with the OB3, which I think is probably the number one big win for small business, because I'm all about Main Street small businesses. And this is really
how that goes. Every 4 years, we're the backbone of the economy, and then we get forgotten about for 3 years.
Exactly. Yeah. And so, it's like we want to make plans as well. And it's like you're living on a swivel saying, hey, am I going to get to take this? Should I accelerate stuff? So this really, I think, makes it great for the small business community to remain competitive against big business and continue to be, exceptional in all that we do, and give us some beneficial tax treatment, because, it's hard out here, and, we're doing things a little different by running small businesses in this day and age. So
now, and there's some other advantages with purchasing things, being able to speed up depreciation, whether it's equipment or real estate. Can you touch on that a bit?
Yeah. So another big win in the small business world, particularly, is going to be very helpful. So we got a couple things back. We've had the option for Section 179, which I will mention. People know that code section, but we've had that option, which is kind of an expensing option for assets. We got higher limitations on that, which is great. But the big one is we got something called bonus depreciation. This is basically a political football that everybody throws around. And my entire career, it's been all over the board. But we had 100% bonus depreciation in the early years of Tax Cuts and Jobs, and they were phasing that deduction downward to completely be gone by the end of 2026. So currently, before the passing of this, it was going to be 40% this year and 20% next year. Now they've taken that limit back up to 100%. What that means practically is that if you're a business owner who's investing in some type of large capital improvement, you're going to be able to have the choice. Now, it's not a right fit for everybody, but you're going to be able to have the choice to deduct the full cost of that fixed asset in the first year of service. And even to the point that it may force your business into a loss on taxes on paper. But again, with good planning, that actually could be a real benefit, particularly if this is like a side hustle and you're making early capital investments and things like that.
So when you
this
say
is
a
a big
fixed
win.
asset is, I mean, that's farm equipment for farmers. Does that include real estate?
So somewhat, it depends on as most, I'm an accountant. I still have to say it depends, right?
Right.
It depends on the type of asset. So most big real property stuff that like the structure of the house, we're not going to get to take bonus on that. But we can take it on such things as like leasehold improvements, maybe some HVAC, big, equipment purchases invested in, appliances, kind of major renovations, things like that. Those things might then qualify for this additional bonus, which again is really helpful to people who are in real estate.
Yes. So not the brick and mortar, but the stuff inside, maybe.
That's right.
Okay. We know that applies to vehicles, and I had mentioned farm equipment. Is there anything that's excluded from that other than the brick and mortar?
I mean, really just the physical properties, I guess, are excluded, like, the exterior structures. But beyond that, no, this is a pretty broad category. We're going to be able to include a lot in this.
Thank you for tuning into this episode of Wealth on the Move, the podcast, brought to you by Hoffman Wealth Management. Here at Hoffman Wealth Management, we focus on working with busy families and active retirees, helping them navigate the complicated scenarios of their wealth while building the life that they desire. And we believe that every financial journey deserves direction. That is exactly what our proprietary process, the HWM navigation formula, provides. Just like a GPS, our navigation formula begins with two key questions. Where are you now? What does your financial picture currently look like? And where do you want to go? What goals and dreams do you have? From there, we help you navigate every financial turn en route to your desired destination with clarity and confidence. It's more than a plan, it's a personalized path forward. If you want to learn more on how the navigation formula can work for you, reach out through the contact options in the show notes below. We would love to help you chart your next move. Now, back to this episode of Wealth on the Move, the podcast. Okay, so when it comes to our businesses and types of structures, we know there's all kinds, sole proprietors, LLCs, S&C. Do we need to be considering making any changes to how our businesses are structured? Or is there anything that is more or less advantageous now given the OB3 passage?
It's a good question. So I think that this comes into play for, I would say, a majority of small business taxpayers is that I am always out talking about entities that people operate in, and not necessarily with the OB3, but with one exception. I have one kind of cool caveat that might change your mind there. But I think just in general, a lot of small business owners don't really understand what entity they're even in and whether they're using it to their full advantage in general. And so this isn't necessarily prompted by the OB3 unless you're thinking, oh, maybe it's, an opportunity to do something different. But I think a lot of small business owners could get a lot of value from making sure they're in the right entity in general. One kind of really cool newbie thing that happened with the OB3, it's been around, but it got a little more juice, is there's something called qualified small business stock. And this is a super narrow thread. It doesn't apply to everybody, but it's helpful for people who are doing startups. And if you basically create a C corporation and you hold it 5 years, you're able to exclude up to $15 million in capital gains tax-free if you do that. So again, lots, we could unpack that for hours because there's a really
my mind's already racing. That could be another episode, right?
Yeah, it doesn't apply to people like us. So sorry. But if you're in a startup business and you're considering any kind of exit or, sale or something like this is sort of what I say is like the
So if you are helpful. in the garage with the brand new technology that no one has heard of yet. This is when you should be making those considerations.
Absolutely. Yeah. If
Okay.
you're building something new, particularly in the tech space, AI space, something like that, it will be worth your money and time to get a consult on whether qualified small business stock that's under code section 1202 is a good fit for you. It could literally, that advice could save you millions of dollars.
Yeah. But for us fogies that are established, keep your head down and keep going.
That's it. Yeah, we don't
Okay.
get, and then they made it further like anybody in professional services doesn't qualify. So we don't get any of that.
Now I got to invent something. What about payroll taxes? Any updates there or compliance shifts or something? Uh-oh.
Golly, payroll.
If you're listening, you should have seen her face.
Payroll's gonna be see, I forget. See, I make some really good faces too. My
Yeah,
face
well,
tells
and
a
our
lot of
YouTube
stories.
audience will benefit for certain.
Payroll's gonna be a whole thing, and I was prepared for more of a thing. And
Okay.
then just yesterday, the IRS issued guidance and they said, yeah, it's not going to be a thing. And we're not going to make any changes to the payroll forms, which is interesting because
I mean, it's still
if you've
July
heard,
or it's August. I guess we still have time for them to change that again, right?
well, we do, but it's like there's so many things that happened with the OB3. So the big ones, we kind of didn't even talk about for individuals. They added this no tax on tips
Right.
deduction, or a kind of midline deduction on that. And then they added this no tax on overtime. The big problem with overtime is that's not reported on payroll forms. And everybody thought, in industry, we thought, oh, well, we're going to get a change to the payroll tax forms because how on earth are we going to know how much overtime people earned in order to give them the tax deduction? And the IRS is like, oh, yeah, we're not doing anything with that. So there are changes on the payroll side.
So it's just on our honor?
I have no idea. Well, to be determined.
Right.
I don't know.
Okay.
Yeah. So we aren't going to see any major changes to the forms, but there were a couple big things that I think are going to play into for employers who have people on payroll. Yeah, we have an addition of no tax on certain tips if they're in a tipped industry, and we have no tax on overtime. And the overtime portion, the way that that's going to work is just the half. So if you're a worker who gets time and a half, the straight time part is still taxed regularly. You're only going to get a deduction for the half, which makes it even more confusing. And just to add, salt to the wound, I have no idea how we're tracking or looking for any of these things, but hey, who cares?
We'll figure it out. Right. What about hiring? Any incentives for hiring or investment that was highlighted in there?
One big one for investments is not a lot of people I think knew about them, and maybe they'll get a little bit of play now, is something called a QOZ, which is a qualified opportunity zone. And this is for individuals who have like ownership in portfolios or real estate that has earned, appreciated. They sell it, they can reinvest it into a qualified opportunity zone and defer or eliminate basically the taxes on the gain. It looks kind of like a 1031 exchange, but without as many rules. So QOZs have been around since 2017. They got renewed and expanded with this OB3. And I think that we might see some more opportunities. They are really cool. The difference on the QOZ is it has to be invested into a disadvantaged area. So the idea is to invest into areas of our country that aren't, kind of doing as well. And you can put investment in there. And by doing so, they're giving you a tax incentive for doing that.
But that incentive is only if you are selling something, having a gain, and reinvesting it. There's no advantage to the initial investment?
Correct.
Okay.
Mm-hmm. Yeah, these are going to be reinvested dollars.
Okay, so the big question, if I'm a business owner listening right now, what is the one thing that I must do before the end of the year other than call Will or Kelly? What is the one thing that I must do before the end of 2025?
So this is funny, but you absolutely must have books that are in order.
Okay.
And so the vast majority of small business owners, they want to kind of jump ahead to like some magical tax plan. And
Yeah.
I have this conversation all the time. And they're like, well, how do I save money in taxes? And I was like, well, let's see your financials and see how much money you're making in all of these various things that you have going on. And this is, lots of entrepreneurs have lots of irons in the fire.
Sure.
If you don't know how much you're making in real dollars in the here and now, I'm just chucking darts at a wall.
Yeah.
I don't really know because I can't give you good concrete advice.
Yeah.
And
Books and
so,
records are so important.
so important. So if you don't have good records in place and you don't have books and you can't tell me or you or somebody who's advising you, I'm making X amount of dollars from this particular entity through this period of time, there's very little that I can do because I'm just kind of theoretically giving you guidance, but not giving you
Yeah.
hard numbers.
I want to talk about something. We preach it at our firm to our clients. I started out the episode talking about it, but I want your insight because you're on the side that we're telling people to do is more than just tax preparation. Because all tax preparation is a history book of everything you did financially last year. That's all it is. Telling the IRS how much of what you did they get a piece of. When it comes to overall tax planning, what processes should people be going through at 35 to make sure when they're 75 they're not regretting not doing that? Because it's easy to talk about, well, I should start investing because I can see the growth potential and I can see I know that at 75 inflation is going to have an impact and I want money to keep, but they don't take the same approach to their taxes. And taxes are a giant portion of everything that's going to impact them. So when it comes to lifetime tax planning, what processes should folks be going through and starting now, really regardless of any age?
That's a great question. So, yeah, and I think that we had talked about this. This is where we have a lot of alignment. So, tax planning is not just a today conversation, it's also a future conversation. And so I always say for every pro, there is a con. And so just because you did something today, it sometimes has a reverse effect at some later point.
Sure.
And a large portion of tax planning is understanding if you take a, quote unquote, more aggressive savings position, say you dump all of your money today into a pre-tax 401k, what is the flip side implication of that when you go to retire? And if you take bonus depreciation in your business today, what is the flip side implication when you go to sell that fixed asset? And so all of tax planning is not just today having the conversation for where you want to fit in the tax world and from a financial perspective. And you're right. I mean, the reason taxes, I get super passionate about it, but it is the largest expense that you will that most people will have in retirement.
I mean, you think of these 401k or IRA millionaires, they have a 40% beneficiary that is 85 million people they never met.
Yep. They are sitting on a cliff of future taxation that they never intended and they never planned for. And now they're, sort of scrambling. So I think that the holistic look at your whole life and what works for you and what your goals are is the bigger part of the conversation. So when we do tax planning, we kind of break it down first is we love to make sure first that you're in the right vehicle for the right, tax structures, right? So there's a lot of different vehicles and I kind of touched on like entities, particularly if you're a small business owner, you got to get this entity thing right.
Yes.
This is not a time for being a cowboy and Googling it on the internet. Like you got to have this thing right because the tax code is written for entrepreneurs, but there's a lot of stuff in there that you have to understand how to play the game and how to jump through the hoops.
Yes.
So having the right entities in place and then talking about not just your today decisions, but what does 3, 5, 10 and retirement look like for you? What's your personal goals? And then we can build a more long-term tax plan. And so that's kind of not just, today, but also for the future, because over your lifetime, the goal in tax planning is to have you pay overall less in taxes over your lifetime, not just today.
Yes. And that's, we say it, we preach it, especially when folks call in for a giant distribution of an IRA. And my initial reaction is, talk to your accountant first, because this is going to change everything, whether it's taxes on your Social Security and what you're withholding. Do you need to be worried about quarterly estimates now? There's so much that it goes into this. I just had this conversation with a client the other day, and her response was, the stuff that you have to think about is amazing. And it is. It's not just send me my money. Is this going to increase your taxes on Social Security? Are you not withholding enough, and now you're going to have to withhold more than necessary next year? And it's, yes, the stuff we have to think about for people is exceptional.
Yeah. And you know, retirement is sort of when everybody starts to think they now need to talk about it. But I really want to, encourage people to have these conversations and thoughts well in advance, because just like you said, you could need this cash for some purpose and it's your money. You should take it. But what you may not know is, like you said, you may cause taxation on Social Security. You may cause yourself to owe more in Medicare, which is a pain in the butt for 2 years. Like, you end up with all these extra costs that if you just planned a little ahead, you could have prevented.
Yes. All right. We have some rapid fire. This is the most fun part that I have. First thing, what is one tax myth that you wish would disappear?
That you pay higher taxes if you're in a higher bracket.
Okay.
This whole idea, people don't understand that we have a progressive tax bracket. And so for some reason, they think that if they get bumped into the next tax bracket, that their taxes magically just get more expensive. But it only gets more expensive on the new money, not all your old money. Like, it doesn't, you eat through each bracket as in your earnings. And it's just always confusing to explain to people. But I wish people didn't think that.
Mine is that when you're going to be in a lower tax bracket when you're retired.
Oh,
that's the fallacy that is. And I remember sitting in the company I went to work for right out of college. They treated us very well. They had the 401k folks come in and kind of teach us about this plan. And I remember it very clearly. Well, you should use this because you're going to be in a lower tax bracket when you retire. And now, being on the other side of this profession, I never see anybody in a lower tax bracket.
You're very true. That's very true.
One thing you always tell clients at the year end:
don't spend money that you don't have just to get a tax deduction.
Good. So some personal finance mixed in with tax advice.
Yes. So, just because something could be a tax deduction, if you don't have the cash for it, why are you going to give me $100 in order to only get 30 back? Like, that's kind of how that logic works. And so just don't do that.
Okay. What's your favorite money book? Or I was going to ask what your favorite money podcast is, but we know it's Wealth on the Move. So let's talk about what's your favorite money book.
This one was hard for me. I have a lot, I love reading. So I feel like I have a new book every couple weeks that I'm reading. I guess in the past, maybe year and a half, a great one that stands out is 10x is easier than 2x.
Yes. I've been listening. I haven't read that one. I'm listening to it.
It's excellent. And again, just a mindset shift. So I don't know if that's exactly a money book, but I think everything kind of relates to money at some point. And so, yeah. And if I'm just listening to another podcast that I want to feel good and fired up about my life, I listen to anything with Gary Vee.
Yes. Yeah, he's awesome. Gary Vee, Dan Martell, all of those guys. Patrick Bet-David, I get into all of their stuff.
Yep.
All right. And we have a tradition that I have completely copped from the Diary of a CEO podcast. Something that he does that ties all his guests together that we've started doing here on Wealth on the Move. And I have a question from a previous guest that they want me to ask you, and then you're going to get your opportunity to ask our next guest a question. So
okay.
Our previous guest was Andrew Updike. He is an analyst with First Trust, and we had a great conversation about what the market did in the second quarter and what he kind of saw looking forward for the third quarter of the market. And it's a conversation we have with folks every quarter, try to find different analysts or folks to add their insight. But his question was, if you could go back in time to be half of your age, what advice would you give to that person?
Okay, so I won't have to say my age out loud. Don't be so scared to let your light shine. Okay,
awesome stuff. That's mine too. Quit being so damn afraid. That was mine as well. Okay, now your turn. And most of the time I do know who our next guest is. I'm not going to reveal that to you yet. But what question do you have for our next guest?
Oh, okay. This I wasn't on my list. I wasn't prepared for this. Now I'm on the fly. Okay. Question for the next guest. You already did the go back in time. I always like that one. If you're standing at the end of your life looking backwards, who did you care way too much about today that isn't there?
Wow. Okay. That's some deep stuff. Deep stuff. Dare I ask you to answer that question?
I think it's just a general, I approach this kind of like when I have some, like a random client or even employee or something like spurs on the day. And I think that we make such mountains out of molehills when in reality, if we look back at the picture of our life, the
It didn't
majority of
matter.
people who are
Yeah.
there are our family, our closest, circle, and all these other people are really not there.
Nope. Noise. Just noise. All right. So a couple things coming up. You have a book coming out, right?
I do.
Tell us about that.
So kind of one of my passions, as I kind of mentioned, is just like helping baby entrepreneurs figure out how to get started and answer a lot of their questions. Same thing kind of along the lines of, I don't know, I think I felt scared to ask a lot of questions when I was early on. And I think a lot of people feel scared to ask questions because they think that they're dumb. And it's not dumb to ask what you think are simple questions. And maybe they are, but it's not dumb to ask. So it's called Just Start Here. And it's basically 10 steps for how to start a business. Super practical, super down to earth, and just kind of going through what I think are these practical steps that you should take and understand what a lot of terminology is. Because I think people start entering circles and people talking all these high level words and they don't make sense. And if you're a baby new entrepreneur, you're sitting there like, I don't even know what this word means.
Right.
And I feel like I'm not able to ask.
Is one of those tips to get your books and records in order immediately from the start?
Well, it's actually to get an entity.
Okay.
But yes, I do talk about books and records
Yeah.
and how to lay out financials and what all the words mean that you don't know what they mean.
When is it launching?
It should be out, I think, within the next 60 days.
Okay.
I'm waiting on my final cover design approval.
Where will folks be able to find that?
I will have it on probably all of my websites. So my company website, DKTBS, and for my eLab, live4elab.com and lifeuntaxed.com. So any of those.
Okay. And that's my next question. Where can folks find you and follow you and find when you do launch the book?
So most of my social handles and things online other than my name are going to come up under Life Untaxed. And that would be on Instagram and TikTok and what else? YouTube and all of those places. And that's just kind of where I generally muse about tax tips or how to live also and grow a business and not be completely overwhelmed by all the things that come at you, and how to remember how to be sane in a crazy world.
Yeah. And everything will be in our show notes, regardless of where you're listening. And is that the best way if folks need to engage your services right away because they heard this and said, I need help? Is that the best way to get in touch with you also, is through those social handles?
Yeah, socials, or like I said, our main website, dktbs.com.
Okay.
Our company, and I have a whole team of really great tax advisors that are highly educated, highly qualified, and this is our passion, is advising. So if this is, something you need further guidance on, we would love to help you.
Awesome. Well, thank you so much for clearing up OB3. I know I learned something today. Hopefully our listeners did. Make sure you check out our next episode of Wealth on the Move of the podcast. And if you need to get in touch with us, our website, hoffmanwealth.com, is the best place. I'm very active on LinkedIn. I think that's how Kelly and I paths crossed, was on LinkedIn. But until next time, please remember to keep your wealth moving.
Kelly Bender and Total Business Solutions are not affiliated with Hoffman Wealth Management and Private Advisor Group. Hoffman Wealth Management and Private Advisor Group do not provide tax advice. This presentation is not intended as specific tax advice for any individual. Please consult with qualified professionals for this type of advice.